An equity swap is a financial contract that lets two parties exchange the returns of an asset without actually owning it. At its core, this is a derivative contract. You are not buying the stock itself, but rather the performance of that stock. Because you do not own the asset, you avoid the administrative burdens of holding physical shares while still capturing price changes. One party typically receives the stock's growth, while the other pays a standard interest rate plus a fee to the counterparty. Unlike buying a stock directly, a swap provides synthetic exposure, which is common among institutional investors looking to hedge risk. These contracts are marked to market at regular intervals, meaning the parties settle the difference in performance over specified periods. Remember that these are complex instruments, primarily used by professional traders to manage risk or adjust market exposure efficiently. Equity swaps are a powerful part of modern finance. Be sure to subscribe for more breakdowns. Educational content, not financial advice.